an experiment that's going to happen that should make a difference in helping us identify what makes sense, what doesn't. Because some things make sense on paper, and you look at them and scientifically they look right. Scholars, as per Denis, think that tokenized property will be worth the non-tokenized property. So the same property, tokenized and non-tokenized, will be worth different. We'll hear more about that from Denis, the person who wants to do the experiment and wants to do it for obvious reasons. It serves our purpose perfectly. The second thing we'll talk about is some partnerships. Getting things done in a way that does add value to every single person who's using our solution, who's using our marketplaces. The third thing we'll be talking about is, and we'll be talking about much more in the interim. You know that when we start a subject, it doesn't really strictly go by that subject, but this is what we want to try to stick to. The third thing we'll be talking about is something that's happening as we speak, and actually happened. It's confirmed, and Denis will start on this block chat telling us about it. So again, it's a block chat. Denis Petrovcic, Makram Hani, and on we go. Denis, what has happened?
So what happened is we formed a partnership with another blockchain ecosystem, and we've been discussing internally of, now we built our solution on Ethereum. This is our core, but so many projects are building cross-chain, and we want to be kind of essentially chain agnostic. So we went out and started connecting with different ecosystems, and some ecosystems are very well funded and are able to kind of offer grants even for those things to happen. And I'm quite proud that we're able to make this initial partnership of doing an MVP with Near. Some might know Near as one of the most well-funded blockchain layer 1 solutions out there. It kind of tags itself or markets itself as a competitor to Ethereum, and it already has some really, really great projects building on Near, like, for instance, the Graph, which we use for querying on-chain data of our tokenization system. So the idea of this partnership is to bring some of the real estate value we tokenized on Ethereum to bridge it to Near as a protocol, and make it available there for their ecosystem. So this is kind of the scope of this MVP that we
won the grant already, yeah?
Exactly. So it's a 3-stage thing so with different milestones that we want to achieve. And I believe we're one of the first partners with Near on the real estate vertical. So I think that's really important as well. I hope we're able to do certain presentations together with them, and that should help and be of interest to our community, because this is kind of a growth opportunity for us as well.
So does it mean that we're abandoning Ethereum by any means?
No,
definitely not.
No, definitely not. I mean, our core tokenization system will remain on Ethereum, and the scope of the MVP is to bridge some of the tokenized value that we've done through or for Ocean Point and staking Ocean Point. Selected properties would be then migrated through this bridged, I would say, to Near. So that
I believe, am I right to say, Denis, it's better to say, or it's right here to say bridged, not migrated, because they will still be on Ethereum. They will still be using the same technology, yet they will be available to people on a different ecosystem.
Exactly. So you use a bridge to put a coin or a token to lock it in a contract, and then kind of mint the same supply there. and then be able to also reverse the process and go back to just Ethereum, for instance. So this is kind of the scope of the MVP. It's like the easiest way for us to achieve an important goal. And so this is step number one. That might in time evolve, maybe through a partnership with a real estate company that wants to, that's kind of supporting Near, that wants to run a marketplace on Near. And at that moment, we would probably use the same tokenization system and fully deploy it as well on Near, so that it's Near native there. And the marketplace would be then usable there and available for the whole Near ecosystem.
I always hear people talking about, okay, do you have a use case for BST? Would that offer or allow us to offer any use cases for BST? Or opportunity to collaborate in the future, and would that allow people who are currently using tokens that are on Near to communicate with our economic system?
I think there might be use cases that are related to it. I think even Ocean Point as such, as a DeFi protocol, might be also kind of then either rebuilt for Near or bridged to Near and vice versa. So I see this.
There's much possibilities.
Cross-chain, yes, indeed.
And because we're venturing into possibilities as we go here, yeah?
Yeah, I think it's like there might be a world where there's one blockchain to rule them all, but there's also a world where there's multiple blockchains that evolve more in certain markets and certain blockchains evolve more in other markets. So being kind of cross-chain agnostic, at least to the bigger players out there, I think that's a direction that we should pursue. But as a project with a small team still, we need to choose our battles, and I think this is kind of the Near is something that protocol blockchain that offers support for that
and
kind of.
It's a safe bet, yeah.
Yeah, exactly.
It's a safe bet, and at the same time, it offers us so much upside. It allows us. It's another channel. It allows us to interact with a different economy, as we said, and possibilities are there to be evolved with time and to grow with time and to be experimented with time. Let's talk about, because we mentioned experimenting here, about your experiment, and then we talk about other partnerships that may be adding use cases to BST that we've just mentioned, and we'll be adding also transparency, would be adding visibility over things that no one has currently visibility for, and will allow people to have visibility where they don't have today, even when they buy real estate in conventional manner, visibility of. So let's start with your experiment. What do you have in mind, Mr. Denis?
Well, I call it an experiment, but essentially it's like we built this to be used in this way, and we've done, I would say, one tokenization ourselves, where we experimented if there's a market for tokenized real estate, if there's people that want to purchase a fraction of a property. We tokenized a parking space in 2018. So that was kind of an experiment at the time. But I remember at the time of researching real estate and tokenization, which was actually, it was really hard to research. There was nothing there. But there was a US-based professor that I actually had a call with, I think in 2017 or 18, who wrote something about the liquidity premium and real estate tokenization that relates to it. And he made an assessment in that short post of how much scholars, as he researched, would value the liquidity premium. And I think the benchmark was something like 20%. So the idea there was you have two houses, one next to the other, built at the same time. So same views, everything is the same perfect copy. But one is searching buyers traditionally, while the other one is tokenized and has buyers online buying it through the purchase of tokens. And the assessment is that the one tokenized would be able to sell for a premium over the price of the one selling tradition. Now, is this true?
Why? Let's discuss why first, if you don't mind.
Okay, let's discuss why. So the reason why is because we might, or buyers might, price an asset to be more valuable if it's easier to liquidate it, if there's a larger pool of buyers for it. And because of it, the value of that asset should be higher.
Okay.
Because it's easier to access and it's easier to liquidate, so it's more. It gives you more flexibility.
Okay, I see a point here. So what you're saying is that it's more liquid, and obviously a more liquid asset usually has more interest in it, and also because in general real estate is defined by the return or by the utility, which can be use or return. Here we're talking about return. And it's defined, everything is defined, return relative to risk, yeah? So here, when you are able to liquidate faster, it means it's more accessible, it's less risky in a way or another, probably in people's eyes, and then it should be earning a smaller percentage, because currently cash, for example, earns much less than property. And that's the logic about it. Okay, it makes sense, but is there any other reasons? Is there reasons that make someone pay more for a property that's tokenized than a property that's not?
I think it's the market size. Like, let's say that we just look at real estate traditionally. You have an apartment and you're selling that apartment, but there's nobody buying it. So you want to sell it for $1 million, nobody's buying it, so you need to decrease the price to 900K, and then maybe you get one buyer. But if you would decrease it to 800K, you would get 10 buyers. So that's the
so
logic.
The dynamics of supply and demand. You had one village looking at your property, now you have the whole world looking at your property, yeah?
Exactly. Yeah.
So, yeah.
And here with the tokenization, you have a way larger pool of buyers that can come in. Theoretically, obviously.
Because it's not only evincity based. Yeah. So today, let's say you have a house in Slovenia, and you have a market, captive market. Let's say the market is 1,000 people who know of that house. However, out of those 1,000, let's say there's 100 who can afford it. Now, obviously, if you make the entry ticket to that house, rather than being at 500,000 euros, make it 1,000 euros, the 1,000 will be able to afford it. So now you have 1,000 to know about it, and the 1,000 are able to afford it. That's 10 times more. That's 1,000% more of people who are able to look at it. Now, imagine that the same house you put on the internet, or forget the internet for a second, you put on CNN, or you put on Bloomberg, on a show that is seen by 2 billion
millions.
people. 2 billion people. And now you reduce the entry ticket to $100. You do the maths. I'm good at maths, but not this good. So, okay, that's a second logical reason. Is there any other logical reason? I can find a reason, for example, similar to people in different locations look at property differently. So, for example, if you're in Slovenia and your average property there earns, let's say, 1 to 2%, let's say you're in Canada and your average property earns 1 to 2%, and I'm in Dubai and my property here earns 5.5 to 7%, let's say you want to buy in my market, you may be so happy with a 4% because it's double what your property earns there. So your money in real estate in your market earns half what it can earn in my market. Half when you're going down, it's 100% when you're going up. So 100% more. While if I want to value a property, if it's earning $55,000, it would be valued at $1 million because I'm expecting 5.5%, 5.5 as a cap rate, 5.5. However, your cap rate would be 4. So you'd be expecting to earn 40,000. Yet, if it's earning 55, it would be worth something like 1.3 million for it, for example. And then logically, that may be a case. Now, again, guys, we're not saying that that's exactly what happened. That's why we're calling it an experiment. So actually, the technique and the process behind it is not the experiment. That's what we've built it to do. What's the experiment is what we're putting out and what we're expecting back. The redundancy, the reaction of that is something that we're looking to monitor and to understand. And we don't want to be arrogant to claim that we know exactly how will the dynamics work. Is there anything else that would make that, in his view, again, that's in the professor's view, be worth more?
I can search for the article and maybe we post a link somewhere in Discord or something like that, and then we can take the discussion there as well after this block chat. But on top of my mind right now, I don't actually know if there's any other reasons, but there might be. I know he went more in depth of the liquidity premium and how to calculate it. So
the premium he said was 20%?
I think it was like as a rule of thumb, he concluded that it should be around 20%.
You know what? If I want to look at the liquidity premium, I can simply look today at the impact of reducing the cash availability and liquidity, and I can figure that out from what the Fed is doing today and the tightening that's happening there, because that's an impact of liquidity tightening. Yeah, so less liquid. And when mortgages are less available, it immediately impacts the value of real estate, isn't it? Because it will impact how much people can afford. That's the rise of rates. At the same time, when less mortgages are available or less cash is available with organizations, they will be selective about whom do they lend it to. Yeah, while when they have so much cash and they don't know whom to lend to, they want to lend it left, right, and center. So it makes sense what he's saying. What the professor is saying makes sense today in a conventional word, isn't it? So I believe it should make much sense. That's cool. So what are we planning? What is the experiment that you're planning to do? You're thinking to do?
So the experiment I'm thinking to do is basically something that. So we've been discussing about valuation of property quite a lot, especially when we do this asset onboarding calls. Right now, it's Makram, Julia, and myself making those calls and discussing property. But in time, I guess it's going to be spread to a wider community, and we'll have also Daniel on those calls, etc. And then maybe some people from the community who want to get engaged in onboarding assets. But we're talking about real estate and property valuation and how it's done. Right, so you have two ways of valuing real estate, or two methodologies. One is the more traditional, where the appraiser takes a look at the property, takes a look at comparable property transactions, market trends, and puts that into the formula, and they receive a valuation. And then it's also differs if the valuation is done for the bank, for the purpose of if the bank is ordering the valuation, or if the owner of the property is the client for the appraiser, which is weird, but that's how it is. And it can
by the way,
it
by
shouldn't.
10, yeah, it shouldn't. The variation that's allowed by the likes of RICS, RICS, and the likes is very limited. Yeah, but yes, I feel you, and I understand exactly what you're saying, and we live it. Yeah.
And then there's a new way of valuing real estate, which has been emerging for the past decade, I would say. which uses machine learning to analyze huge amount of data and then output a certain price assessment for a certain real estate asset, depending on the input information, like how big is the usable area of, let's say, an apartment, the year that it has been built, the state it is in, and stuff like that, obviously impact. But essentially what it allows for a bank is to basically just automatically get a valuation for all the mortgages they have in their portfolio, which reduces risk for banks drastically. So it's an amazing product, and there's several companies that provide this either through an API or through a UI.
It's a live view, so they can understand live what is the level of equity in their portfolio.
Exactly. So imagine that you, as a bank that is lending to somebody to purchase a property. Right now, how it works is you go to the bank, you file for a mortgage, you receive the information you need to pay for processing, and then you need to wait for a couple of weeks to get an appraisal, proper appraisal back, and then they inform you if your mortgage is approved or not. So
for people who are living in Dubai, where it takes approximately 2 days to get the valuation report done and everything is processed, that doesn't apply perfectly. But yet, it's the same process. It takes 2 to 3 weeks minimum to finish the basic of the process.
I mean, it really depends on the market, but let's say that it's not something you do overnight.
100%.
While with automated valuation, you could receive that information automatically within the hour.
And again, that's great for a bank because it reduces risk. It gives them more visibility of their portfolio and how is the portfolio reacting to things that are happening around. Yeah. And at the same time, it may reduce their non-performing loans because they can approximately have a preventative measure where rather than only being a proactive sometimes with collections, they have a predictive opportunity here, and that predictive opportunity is based on all of the data collected and analyzed. Perfect. Okay, cool.
So now with automated valuation, we have a real world estimation based on real world transactional data for a real estate asset. Let's say a student house in Ljubljana, for instance. That's something I control, so I know I can do it. So imagine we do on a daily or weekly basis, we do an evaluation of that asset based on comparable assets, which are other houses surrounding. Those houses might have been sold because for the usage of it. So, probably a family buying a similar house. And most of those houses are probably not rented out and haven't been purchased for it. So you don't know from that data why somebody purchased the property, but they're valuing the property in one way. And then we tokenize it 10%, maybe 20%. So the more we tokenize it, the more reliable the information on the pricing of the token
should be.
So the token valuation.
Yeah.
And we can gradually expand the experiment. We can start by tokenizing 1%, offering at a certain valuation, and then seeing what happens. Why? Because we also can open up the secondary market. So people can transact with the tokens of that asset, and they will have the token valuation will have a different valuation than the property valuation, which is retrieved through that automated valuation service. Now, we check one versus the other in a certain time span. And we can compare how the market would kind of assess that liquidity premium, or let's just simplify it, the value of real estate tokens versus real estate as an illiquid asset.
Okay.
And we can add to the experiment in time. Let's say we then have 5% of the asset tokenized and sold to the users, or to people who want to purchase real estate tokens. And then we can do another 5% and reach 10%, etc. So we are increasing, but we need to have increased demand for that asset. And we're doing this experiment to understand how price is impacted on one market versus traditional market. So we will have a perfect example, because the data in the automated valuation has nothing to do with the price of the token. It doesn't have that information, so it's not impacted by tokenization.
So actually, this gives us plenty of data, including, again, a predictive possibility or ability to what is coming in the market. Because if we can understand from that sentiment and the impact and the change in the value of the token, or how much someone is ready to pay for it, because there's a theory that says what real estate is worth is what somebody is ready to pay for it. And the change in that value means change in sentiment, or what people evaluate that liquidity or that asset at, and that income at. And this is making it an instrument which is different than real estate today. So real estate today is an asset and that is of a different characteristic, isn't it?
Yeah, I think it is. It should have, the end result should be the asset valued by the automated valuation will not be the same as the token value.
And I would say
that's the outcome. That's the outcome. But I don't know, because it might be opposite, because the market is not big enough.
But Dennis, I believe that's exactly how it is in today's market, but we don't notice it. So today you have a valuation of the property. Forget about how we value property today, and look at the average valuation, which is actually, you know what? Look at replacement value. Forget about valuation, because that is in general a number that very little moves up and down. Sometimes a property sells way beyond replacement value. Sometimes it sells way under replacement value. And that did not change replacement value or the cost of buying a property or building a property. It just reflects what people feel about owning the property and what people feel the value of property is today. So actually it's happening today probably, but we cannot measure it maybe today. With what we are gonna go forward with, as I wouldn't call it an experiment on that end, as a process, we will be able to measure it, and we will be able to identify the triggers to it, and in the future expect those triggers. So when this happens, this is how people are reacting, and this is the outcome to what people are ready to pay for property. Now, that makes so much sense. And in my opinion, we should do it. I'm excited about it now. Yeah,
I'm excited about it as well, because we can then do this experiments on different types of assets. We can do it on land, which is not a cash flow generating asset. We can do it on an apartment somewhere. We can do it on a commercial property. And I would love to do it on a sports stadium. That's my dream, to tokenize a sports stadium.
Okay.
Like, that's something I'd love to do. And I'll tell you why.
Tell me.
Because nobody knows how much it's worth.
There's so much emotions also around it.
It's hard to value an asset that doesn't have really comparables to compare it with. Because usually, let's say a soccer stadium, there's one in a city. Maybe there's two if it's, I don't know, London has several, obviously. But it's hard to find comparable stadiums, compare them. It's like,
and it's not always a commercially viable project. It's usually a a project that sometimes does not make much commercial sense. I've written a paper about stadiums in the past, or utilization of property. The paper was not about stadiums. And one of the least utilized properties in the world that costs so much is located perfectly, has parking around it, all dynamics to be fully utilized all the time, was stadiums. And that's why I concluded a way to make stadiums, rather than being utilized 7 to 12%, which is a pity. That amazing property in an amazing location with all of those amazing facilities, with all of this amazing amount of money it requires to build it and manage it and operate it, to utilize it 7 to 12% is a pity. So I hear you there. Actually, there's plenty of stadiums coming up in our neighboring country here, where maybe that would be a solution to the future. And again, a stadium has so much of sentimental value to people. So imagine you tell someone who is a Manchester United fan, or a Barcelona fan, or a Madrid fan, that your stadium is being tokenized.
Oh yeah, I think that's kind of,
there's bragging rights behind it. So I hold a token to the stadium. Cool. Okay, so I'm excited about the experiment. I hope that everyone else is. When do you plan to start this experiment?
I don't know. It's tied to a partnership that we are working on, and as you know, not yet to be announced. But I'm quite excited about this partnership because it's essentially working with a good friend of mine, and we've known each other a couple of years now. We've gone through the same accelerator in Geneva, and that's where we met. And he's just, he's a great lad, and a great father as well, and working very hard on his company. And he really knows this stuff. So bringing this automated valuation to Blocksquare, it opens up other possibilities that we're discussing, like providing valuation data feeding on chain. So enabling DeFi to utilize it, not just for what we do at Blocksquare. This is one thing, but we can actually open it up to a variety of ecosystems and projects in DeFi. Imagine even without tokenization, imagine being able to accept collateral in the form of a property that somebody owns. And if we look at DeFi projects being essentially this banks, basically, they're serving as banks, but I'm able to put 10 ETH in Aave and I get a loan. And the beauty of it is I don't need to even pay it back. I just need to ensure that the value of my collateral is higher than the money I borrowed. And if I reach certain thresholds, it's gone, my collateral. So I'm losing, right? And essentially, this is how banks should service the population. Is okay, you own property, it's worth 1 million. Here's 200K, and have fun. And
so
until
it's not have fun, but go invest the property in something else. It's not for party money. But you're right, 100%. So
it should be like, do with it whatever you want, because if not, I'm gonna seize your property and it won't be fun anymore. So use it wisely, because you will need to repay it at a certain point in time, but there's no actually date until when you need to repay
or to service it, at least. Yeah, you need to either repay it or service it.
Exactly. You need to service it, which means just the collateral needs to be higher than the borrowed amount. And that's it. And that's essentially how crypto lending works, which is amazing, and very competitive to traditional lending. So I think,
and part of this is because it's peer-to-peer, yeah. So the ability to eliminate the middleman, the traditional bank, and have a smart contract act as your central bank that sets rules that you engage with parties on. At the same time, having you and me acting as the depositor and the borrower immediately without any third party in between. So in other words, without commissions and without fees and without operational costs and without any of those, and without biases, because you lend based on a certain criteria that is well defined beforehand. And I borrow based on that criteria also, on something that's straightforward beforehand. So what you're saying is, if tomorrow morning, rather than you putting 10 ETH to borrow on a DeFi protocol, you're able to put a real life asset similar to property, and it can be valued, and it's there, and you simply, as long as you have equity, are running perfectly on it. Now, if you tokenize property and you're able to borrow against those tokens, that's a whole new world of you. And this is why, by the way, people today do not use their crypto. They put their crypto and they borrow against it because they believe that the crypto will be worth more tomorrow, so they don't want to sell it today. Yeah, and this is one of the reasons.
Yeah, exactly. So it's a bit different when you use property to collateralize a loan, because you know that that property is never going to do 3x. So it's going to be hard for you to repay the loan and exit that liability with property.
But hopefully it will also not do 70% down in 2 days.
Exactly. So that's the other side of the medal, which is, it's much safer to borrow against property than it is to, and it's safer to lend against property as well. Yes. So yeah.
So that's a huge dynamic that's open, and when this partnership again, as Denis mentioned, is very near to conclude positively, hopefully, and hopefully we'll be able to announce it soon. When this happens, and we are able to use that data in a positive way, and you'll all be able to have and see that data, have access to it, it adds value, in my opinion, to all ecosystems around. Cool. That's a good thing that's taking place, and hopefully very soon. What do you feel you want to tell our community this week?
What do you want to say to the community?
I want to tell them, think real estate. I want to tell everyone, yes, you can do much with your money. Yes, you can go into investments that may change in value overnight, that you may understand or not understand. You can play roulette with your money. I'm not a gambler. I'm an investor. If you invest in real estate and think about it right, it will offer you that kind of peace of mind and sustainable continuous returns. What we're trying to do is trying to get real estate to you, more accessible wherever you are in the world, so that you are not guided by the proximity of the property to you or by your understanding of your street. You're able to have the same visibility of any property you wish to look at in the world. At the same time, you won't be needing to make sure, although you should look at every move as the right move, make sure that you have done a foolproof move with every property purchase, because you've invested $1 million out of $1.5 million that you own in it. But you're able to invest few thousands of dollars and diversify your choices. Still, you're able, if you want, to own property in full. And here, I say a story that I live, and I believe many others live. If you are in property today, and you have transacted like me, call it 100 property every year for 10 years. That's 1,000 properties. Today, what you have to show for them is nothing. Memories, pictures, isn't it? Actually, I delete some of the old pictures because I don't have space on my hard drive. So with time, you'll not even have the pictures and the memories. I owned all of those properties. Let's say each is valued at $500,000. I don't want to say a million or two. $500,000. Call it 1,000 properties. That's 500 million, isn't it? Am I right about the mathematics?
I think so. Yeah.
500 million. Yet, yes, I made profit in it and I moved forward. Now, you could have made profit or a loss. Thankfully, I made a profit and I moved forward from that. But how about if today I am able, because I chose the right property and I bought it the right way and I tokenized it, I am able to benefit from it the right way, regardless of who buys it and who sells it for the rest of time. Good idea. I believe it is. So for every landlord out there, that is allowing you to reap the benefits of your choices, of the right choices, because you bought property in the right location. And when you sell a token, you did not sell everything but the memories and the pictures of that property. You have a toll on that property forever. Isn't it, Denis?
Yeah, you put it very well.
And that's part of what I'm most excited about, because I want the coming 10 years of property purchasing end up with more than pictures that I want to delete from my hard drive.
Oh, yeah, it would be great to have a portfolio of properties that recurringly create an additional revenue stream for you, because there's a market for it. So we talked about experiments today, experimenting on one single property, but doing maybe more same type of experiments throughout time with the owners that feel that they want to do an experiment with. And this means that I need to do the first experiment. And I'll be the first to experiment with my property, and hopefully you will be then following with experimenting with your property, and maybe we have other asset owners experimenting with theirs. What this will bring is the purchasers of those tokens will also be able to stake within Ocean Point, by the way. So that might create a situation that gives us false results. So we will need to check this. I just thought of it right now, that people might be buying real estate tokens because they are, they want to use them to stake in Ocean Point, and earn BST. So, and that's like an additional revenue stream that was not provisioned for. So we might have not just a 20% premium, but maybe double it to 40%. I don't know.
That's something to be thought of. Yeah, that's something to be looking on a drawing board on. But yes, you're right. And guys, look, at the end of the day, it should make sense. Anything that doesn't make sense doesn't make sense. If it walks like a duck, it quacks like a duck. Most probably, it's a duck. Yeah. So when someone is giving you 200% return on your staking and owning of anything, remember, it is not sustainable. I'm not saying it's a scam. I'm saying it's not sustainable. I'm saying it's not something that can happen.
It's not sustainable. But if, like for BST, we said it's sustainable for the time of 6 years.
Exactly.
Sustainable in terms of distributing that amount of tokens. We're talking about the amount of tokens. Now with the staking of real estate, the APY might be smaller because the tokens would not be valuable. So in dollar value, we would be distributing nothing against the dollar value of the property tokens. But if that value of the tokens is increased, then the APY in dollar value would be magical, and it cannot be sustained above a certain point in time because it's a token that
should become organic. It should become organic. Yeah, it should feed itself.
Exactly. But we bet that in 6 years' time, it will become a very healthy, organically grown ecosystem with pure tokenomics that are cash flow driven from real estate assets that are part of the ecosystem.
So what we tell everyone is, guys, for you to figure out what is going to happen scientifically going forward, although none of us can predict, you need the right data. One of the ways to get the right data is through downloading the Fibri industry report, isn't it, Denis? Because you're able to, and there's one that has just been issued recently, and that industry report provides you with so much data. Actually, it's the benchmark, not only data, knowledge about blockchain and real estate. So Fibri is the foundation of international blockchain and real estate expertise. So I advise you all to go and look at that report, because I believe it can provide you with so much value, so much knowledge that you can utilize when you're next looking at blockchain real estate and tokenizing property. We are certain.
And there's there's a couple of articles that are really make for a great read, by the way.
Perfect. One of them is mine, surely. So I'm sure there's plenty of good articles. The guys are putting so much effort to make sure that it's all full of great content, valid content. We have plenty of academics within the organization who are putting so much effort to do so. So we are certain of the future, and we are certain that in a way or another, this will form the future. We hope that you can have more certainty through scientific approach and through the ability to look at the facts in front of you. Join JP Morgan and others in their drive towards blockchain today, because distributed ledger technologies have proved it lived one cycle, it's living another now, and that's positive. And that will, in my view, drive adoption and much of adaptation of processes within this cycle. Do you agree? Do you see the same, Denis?
Yeah, I think every cycle we get more information about what we're doing.
Don't you feel Don't you feel that this cycle, the big players have started already putting their feet in and their hands in, and they will take advantage of the current slump or the coming slump, and to really establish in that? Or no, you think that it still needs another cycle for that to happen?
Are we talking about the real estate tokenization market right now?
We're talking about blockchain in general, and part of it is what we're doing.
Okay, so blockchain in general, I think, yeah, definitely. But I think it's been like this for 2 cycles right now. So, and we see the shift from the adoption within Bitcoin, and then it's obviously going to other fields as well. But I think this is impacting quite immensely. There's reputable people talking about Bitcoin normally today. The previous cycle, I was a bit skeptical of talking about what we're doing, because at least here people were looking at crypto as a big scam for some period of time. And right now it's easier to talk about it. I mean, it's normal to talk about blockchain technology. It's becoming much more reputable. So the reputation that blockchain is gaining throughout cycles is important.
So I feel that this cycle is the cycle that we will have mass adoption, and very soon we will, at least on a tokenization of real estate level, have achieved full utilization of our technology in the first stage, and we would be entering another stage of utilization. And that has nothing to do with cycles, by the way. Tech is being developed regardless of the cycle and what's happening within the cycle. So great news today. I'm so excited about what's coming. I'm always fascinated with every week that passes and what we do with it, and how we evaluate it at the end of the week. I believe there's much happening, Denis, that is very positive this week, yeah?
Yeah, I also think, I mean, we're progressing at a steady pace. We're doing smart moves. I think that we're evaluating opportunities based on market conditions, and always trying to bring actual value to Blocksquare
Can we talk
and the
here,
community.
by the way, about the first property tokenization in Australia?
Yes, I believe yes.
So
Indeed.
the first property in Australia that has been
confirmed.
Sorry?
I think it has been confirmed. Indeed.
Perfect. So good news, guys. Another city, another country that has been added to the tokenization drive, and I believe much will come from Australia because it's a market with so much potential, and it's a real estate market that's very dynamic as well. And to be honest, it's a standard to many countries in the world. When what happens in Australia is applied elsewhere as well. It's advanced as a real estate market.
And there's one thing. It's an advanced market. It's a very attractive real estate market, and it's not so accessible as you might. It's not easy for people to invest in Australia, although there's very good deals there.
Yeah, and there's been plenty of years now. They've been or how could I say that? Actually, trying to have people non-encouraged from investing in Australia from outside because they're very aware of the market dynamics and they don't want to change the dynamics in a way that the Australian or the community is not impacted positively with it. So that's cool. Mm-hmm. Anything else you want to tell our community, Denis, before we call it?
No, nothing special.
Great block chat. Thank you again for joining us, and hopefully within the coming few weeks we will see much more of each other in live sessions, and we will see much more of each other because hopefully you will send us videos, questions about things you want to know about or ask about, and you want to join us on block chat asking about. Ciao, have a pleasant week.